they loaned $8,000 to Bland Company and received a 6-month 10% note. So to journalize this, we know that it would be note receivable Bland Company. We debit the asset account, $8,000. And then we're loaning out cash, so we would credit cash. Okay, then October 1st, we collect on the note. So we know in this case, we're going to debit cash. There will be 2 accounts that we will credit. One will be for the principal amount, it will be note receivable Bland Company. The other one will be interest revenue. So we could just use the on-screen calculator here. So $8,000 times 10% times 6/12. April's the 4th month of the year, October's the 10th month of the year, so 10 minus 4 means the note was outstanding for 6 months. So times 6 divided by 12 to get 6/12 of the year. So that's $400 of interest. So we credit interest revenue for $400. We credit note receivable for $8,000, and then adding those 2 figures together, the amount that we debit to cash would be $8,400. Okay, the other one, notice it says it's a 180-day note. So here we have to keep track of it in number of days instead of months. And up at the top of the problem, it says use a 365-year day, or day-year, to compute interest on notes stated in days. So first of all, they loaned $6,000 to Flores Inc. So we will debit note receivable Flores Inc. for $6,000. We will credit cash $6,000. Okay, now in this case, the loan is outstanding on December 31st. So unlike the other loan, we have to accrue interest on this on December 31st. So the number of days, you can't just take 1/12 here for 1 month, because again, we're dealing with the number of days on this note. It's a 180-day note. So taking the 31st day of the month minus the first day of the month, that's 30 days. So we only want 30 days interest, even though there are 31 days in the month of December. So getting our calculator out here, $6,000 principal times 12% interest times 30 days divided by 365 days. So rounded to the nearest dollar, it would be $59 of interest that we need to accrue. So it would, the account we debit would be interest receivable, and the account that we credit would be interest revenue for $59. Okay, then, on May 30th, they collected the florist note at maturity. So we know the account that we're gonna debit is cash, and then this is one of those examples where there are gonna be three different accounts that we credit. So one of them will be note receivable florist Inc. One of them will be interest receivable, and one of them will be interest revenue. So the one for the credit for note receivable will be the $6,000. The interest receivable will be to reverse what we did in the previous journal entry on December 31st. So we know that will be $59. Then for interest revenue, that will be from January 1st through May 30th. So looking at our calculator again, we know that we already accrued for 30 days of interest, and the note is 180 days. So that means that we have 150 days left that fall in the current year that we have to accrue for interest for. So $6,000 times, what was the interest rate? 12%? Times 150 days divided by 365 days. That's rounded to the nearest dollar, that's $296 that will show for interest revenue. And then if we add all three of our credits together, that would be $6,355. And that will be the amount that we debit to cash there. Okay. Next one is dealing with bad debts expense and allowance for bad debts. And so here I'm going to split my screen. What we're supposed to be doing is the adjustment on December 31st to record bad debts expense using the percentage of receivables method. So the allowance account here has, they tell us it has a unadjusted credit balance of $2,700. Then for accounts receivable, the beginning balance, December 31st, 2023, was $20,000. Then during 2024, Lake earned revenue of $454,000 on account. So that means credit sales. So on the debit side of accounts receivable, we'll add $454,000. And they collected $325,000, so that's gonna go on the credit side of accounts receivable. And they wrote off $5,600 of receivables as uncollectible. So the journal entry when they write those off would be that they are debiting allowance for bad debt, they are crediting accounts receivable. So on the credit side, I'll put the $5,600 that they wrote off. So now the ending balance in accounts receivable, we calculate that. Okay, 143,400, and then they say that they think that 5% of that's uncollectible. So we take that figure times 5%. That's 7,170. So up where we have our T account for allowance for bad debts, the target balance in that account should be 7,170. So we had a beginning balance of 2,700. We want to get to a balance of 7,170. So the difference that would get us there would be what? Would be that figure minus that figure. So we would have to make a credit entry to the allowance for bad debts of 4,470 to get us to our target balance in the allowance account. So for the journal entry here, we will debit bad debts expense 4,470. We will credit allowance for bad debts 4,470. And at the bottom, we'll put recorded bad debts expense for the period. Okay, then next it says, instead of what we assumed in part one of the problem, we're supposed to assume that the allowance account had an unadjusted debit balance of 2,400. So instead of that $2,700 credit balance, it had a debit balance to start with of 2,400. So don't always assume that the allowance account has a credit balance. Sometimes it has a debit balance. If it has a debit balance, what that really means is they actually wrote off more accounts than they estimated they would have to write off when they set up the allowance. So now, in this case, we used to have we did have a debit balance of 2,400. The target that we want to get to is a credit balance of 7,170. So the entry that we have to make to get there would basically be these two numbers together. So we would have to make a credit entry to the allowance account of 9,570. So in our journal entry, we will debit bad debts expense, 9,570. We will credit allowance for bad debts, 9,570. And at the bottom, we'll put recorded bad debts expense for the period. Okay, then I have just a few multiple choice problems here that you can help me to answer. Notes receivable, which one of these four things would be true of those?
B.
Yes, good. B, they're supported by a promissory note. That's one of the main things that makes them different from accounts receivable. Okay, they give us a lot of information here on a company's debt and their allowance for bad debts, etc. And then at the bottom it says bad debts expenses estimated by the aging of receivables method. Management estimates that $5,000 of accounts receivable will be uncollectible. Calculate the ending balance of allowance for bad debts after the adjustment for bad debts expense at December 31st, 2025. So reading what they give to you here, can somebody tell me what the answer to this would appear to be?
It's 5,000.
Yes. So they're sort of trying to trick you here, making you think it's more complicated than it is. What they estimate bad debts expense to be is what you want your ending balance in allowance for bad debts to be. So that's all there is to it. It should be $5,000, your balance in allowance for bad debts. Okay, historical art is a new business in its first year of operation. Credit sales are 40,000. Collection of credit sales are 30,000. One account is written off for $525. Management uses a percentage of sales method to account for bad debts expense and estimates 2% of credit sales to be uncollectible. The ending balance of the allowance for bad debts account is, so let me split my screen here again. It's a new business, so there isn't any beginning balance in the allowance account, but when they write off an account for $525, despite the fact that there's no beginning balance in allowance for bad debts, the journal entry still has to be that they would debit allowance for bad debts, credit accounts receivable. So we will put, on the debit side of the allowance account, we'll put $525. And then when we make an adjustment at the end of, adjusting journal entry at the end of the period, 2% of their credit sales, 2% of 40,000 would be $800. So then when we make that adjusting journal entry, we would be debiting bad debt expense $800. We would be crediting allowance for bad debts $800. So put $800 on the credit side, and that's all they tell us to do. So then we would balance the account, and so it would tell us that we have a credit balance of $275. So that's answer A here. Okay, which of the following methods requires two entries to record the recovery of accounts receivable previously written off.
It's D.
Yes, we saw in the lecture, both of those methods, we had to make 2 entries to, show the recovery of amounts that were previously written off, yes. Okay, that was, everything we needed to get through, so.